Hello, everyone, and welcome to a series of conversations for year end tax planning and general tax planning to help you make better decisions about your money and some thoughtful tax planning. This is obviously a timely conversation we have every year, probably right around this time, because we want to help you take advantage of any last minute tax planning opportunities and plan for the year ahead. And this year, it's a especially important topic given the number of significant changes that our current administration is proposing. And that's why I decided to invite a few tax leaders from our professional community to hear from them firsthand what they may recommend for a variety of situations that you may be facing. And in this segment, I have the pleasure of having a conversation with Daniel Novak, who's a principal of Brigante and Company, a highly regarded mid-sized CPA firm located right here in the Bay Area. And Daniel presently works exclusively with individuals and owners of closely held businesses. So I'm excited to have this conversation with him. And Daniel will focus his year-end tax planning conversation with us specifically around individuals with stock-based compensation, real estate investors, self-employed, folks getting ready for retirement, or maybe they're in retirement already, as well as just general tax planning tips that I think all of us can find value in. So without further ado, I'd love to invite Daniel into conversation. Hey, Daniel.
Hey Roman, happy to be here. This is actually probably the more fun part of the year for tax. No one looks forward to tax season. Um, but what we do this time of the year, we can actually be proactive instead of reactive. So you can kind of change the outcome. Um, so in a year like this, where there are a new administration, potential tax changes, we really kind of want to try to come up with that crystal ball as best we can. But there are a lot of little levers that can actually make significant differences in your financial life. As we're all aware, California is considered a high tax state. And if you're actually in the highest tax brackets, it's 37% federal and 13.3% California. So just over 50%. So it's actually mathematically impossible for you to spend more money on anything besides tax. So having an efficient tax strategy is actually, really, really important. Um,
Well, I
so
like that with all that being said, you led with this being the fun part of the year. So um, good. I hope this will be fun. So tell us how we can pay less in tax. I mean, there's a lot of things that I think most of our clients, let me just actually back up and say, I would say that most of our clients have someone that's helping them with their taxes. Of course, there are some that still use some online platform like TurboTax. Their situation might not be very complex, but there's still things that we can all do towards year end just to make sure we're not missing anything. And one of the things that I keep hearing from people who say, I usually don't hear from my CPA or my accountant until it's time to file taxes, which, as we all know, happens in the first part of next year. But I intentionally wanted to have these conversations because I'm sure there are things that you can offer for us to think about before this year comes to an end, just to make sure we don't miss anything or don't lose some opportunity that can help us save on our taxes and lower that tax bill.
yeah, so individuals are unique in that you're considered a cash basis taxpayer. So depending on, say if you're running your own business or you have rental real estate, which you're essentially running your own business, you have the ability to shift expenses between years, right? So if you have a piece of rental property that's been very successful this year, maybe you've been able to raise rents, but you know that there's an upcoming expense. The roof needs to be replaced. Maybe you want to actually schedule that work to be done now before the end of the year so you get the tax deduction today instead of next year. There's issues with depreciation depending on the life of the asset and bonus, but that's just one idea. A similar thing, refrigerator, any of those equipment in the house. Also for self-employed individuals getting ready for retirement plan contributions. Those won't need to be made until you file your tax return, which would be April 15th of the following year, or if you extend to October 15th. But starting to park the cash so that you don't have to come up with a potential tax bill on the same day as your SEP contribution, right around the time your first property tax payments are due. It's kind of just a ton of cash coming out all at once, and you'll definitely want to have that, planned and prepared.
So let's break that up because we're starting off talking about someone that owns real estate in investment property.
Yeah.
And so let's dig a little deeper and talk about that individual or that family. So we've been getting questions a lot this year about short-term rentals, like
Mhm.
Airbnb, vacation rentals, effectively. Some folks are getting ready as the world continues to open up more and travel is picking up again. And some have made renovations, have bought new furniture, or invested in their properties. Um, is there anything they should be thinking about in terms of depreciating or writing off those expenses?
I'm actually really glad you brought up short-term rentals. There's some interesting conversations that you should be having with your accountant about short-term rentals because there's a classification. Is it a piece of rental real estate or is it a business? And if you have enough facts to support the conclusion that your Airbnb is a business, you would actually report it on Schedule C as an operating business instead of Schedule E as a rental property. And then you can actually take, it's not limited to passive losses. So you can offset your other income. Um, so depending on this, it generally boils down to the level of service you're offering the tenants. So if it's short term and you're providing additional services, maybe you offer to give them tips on places to eat, you help them, with their vacation, more like a hotel versus a long-term rental where you kind of just give them the keys and say, pay me the rent every month and call me if there's a problem. And that can actually change significantly the tax outcome because often, unless you have a large amount of equity in the piece of real estate, you will be generating losses because of the depreciation. And if those losses are held up in a passive activity loss carry forward, you're not receiving a benefit for them until a future year. So that,
So,
that can be a big deal.
so look, distinguish a little bit about that Schedule C versus Schedule E filing. So, talk about the difference. And when we have, let's say, certain investments that people end up making into their investment property, like buying
Mhm.
furniture or providing other expenses or incurring other expenses and providing those services, would those be deductible regardless of which way they treat this rental property, or is it only one of those two?
Okay. So the standard for deducting expenses, if you go all the way up 30,000 foot level, is ordinary and necessary. So to the extent that the expense is related to the production of that income, it will be deductible. Um, so that being said, the difference between the two schedules is basically whether it's a passive rental or an active business. So if you think of it like a long-term rental versus a hotel, and how do you get your Airbnb, which is kind of this new quasi, it's not really a hotel and it's not really a long-term rental, and
Mm-hmm.
you need enough facts on the hotel side to say I'm running an operating business, I'm not renting an apartment. Does that help clarify?
I think so. I think what you're saying also is consult with your accountant because this is not something you should be navigating on your own.
Correct. Yes. The classification, I mean, Airbnb has been around for how many years now? And kind of by default, the IRS in history would assume any real estate would be a passive activity.
Mm-hmm.
But with the advent of Airbnb and the additional services that many um, property owners are providing to their renters, starts to tip the scale potentially to a more advantageous tax treatment.
Right. Well, I think it's also true whether people are using um, some part of their house as an Airbnb rental versus having a dedicated property that is partially generating or is responsible for generating revenue 365 days out of the year as opposed to this occasional somebody stays in my house type of thing.
Right. There is actually kind of a fun rule if you're ever in a city where a major sporting event is happening, you can rent out your primary residence for 14 days or less, and you don't even have to report it.
Hmm.
So the tax code is full of rules, exceptions to the rules, and very very interesting code sections that if you know them, you can take advantage of them.
So before we move on to the next category of folks that you promised to help us with, let's talk about the retirement, which is another thing that you brought up earlier. Can individuals that invest or, sorry, have rental income, if they treat it as a business, can they offset some of that income and defer it into a retirement plan?
So if you're a real estate agent, you have business income. So that income is self-employment income, and you would be able to defer it into a retirement plan. If you are running an Airbnb, that would potentially also be self-employment income. If you were just passively investing, you do not have self-employment income, so you can't defer it. So there's a lot of kind of push-pull depending on how you can classify the activity.
All right. So talk to your accountant, folks. Anything else on real estate investors or owners of rental properties, or even people that own their own homes? Is there anything, any tax opportunities? I know that we're being
Yeah.
limited by the SALT reduction to what, 10,000
Yeah.
for those that itemize. Anything you
The,
would mention to those folks?
the biggest thing just for homeowners of primary resident, your primary residence, from the day you buy it, since it's not a rental property, almost everything you're spending, you buy a new roof, new windows, new flooring, redo the kitchen, all of those are improvements or additions to basis. So to the extent you're going to stay in your home a very long time, keeping track of that can be incredibly valuable. So for example, I had a client last year that bought a home up in Healdsburg in the 80s for $500,000. They sold it for $3.2 million. And they fortunately had an Excel spreadsheet where it was very simple, but they had date, what they spent the money on, who the vendor was, and how much it was, going back from the day they bought the house. So they were able to capture when they built the pool in the 90s, when they added a guest house, when they redid all the landscaping. And they had, I think it was about $1.5 million worth of expenses, which saved them a little over $500,000 in tax. If they didn't have any record of their improvements over the last 40 years, then they'd be trying to go from memory, and trying to remember what you spent on some windows in 1995 is all but impossible. And you're also opening yourself up to the IRS challenging your claim that you spent that much money. You can take a photo of the house when you bought it and a photo today and try to argue it, but having a well-documented record is invaluable.
I love that tip. It's something we tell our clients all the time. Take pictures, make a file, start a file, save receipts, save invoices. They'll come in handy one day. And this is a great reminder for that. Thank you.
Yeah, definitely.
So, who do you want to take on next? So you've mentioned we wanted to talk about retired folks or folks who are planning for retirement. There might be some income changes in their lives.
Yeah,
More folks.
that's a great one that I feel is often overlooked.
Mm-hmm.
Is individuals that are newly retired, nearing retirement. Is often there's, if you're fortunate enough to retire before taking Social Security, your income often drops. So you have a number of low income years before, maybe you're trying to delay Social Security to age 70 to get the maximum benefit, but you're retiring at 62 or 65. So you have, somewhere between 3 and 8 years where you may be in the lowest tax brackets. But if you have, to the extent you have either a taxable portfolio with built-in long-term gains, and your income for a married couple is about $100,000 or less, you want to actually bring your income up to $100,000 because there's actually a 0% long-term capital gains rate. So you can sell a stock at a gain and immediately rebuy it, recognize that gain tax-free. And then if you eventually sell it in the future, you've never paid the tax. If you don't do that, you're just throwing away those low tax brackets. So that's the most valuable, is if you have built-in gains on long-term assets. Second, if you have, to the extent you have traditional retirement accounts, you can do either in-plan conversions to a Roth account. So you lock in your gains at, potentially at 10, 12% tax. Or if you want the money out of the retirement account, you can actually take a slightly larger distribution so that you're still locking in those gains at 12%. And the reason I try to recommend this is that You'll often see a retired individual where they've been trying to stock so much funds into their nest egg, and then all of a sudden they want to remodel their kitchen, or buy a vacation home, and they want $500,000. Well, if you take $500,000 out in 1 year, you're all of a sudden back up in a 35% tax bracket. But if you kind of plan for that and you strategically roll these funds out of the account, you could be saving 20%. So it could save you $100,000 over a couple of years. So quite significant potentially.
Absolutely. No, that's I think thinking ahead, planning ahead, it gives us options and flexibility. And clearly, in this case, it also gives you a lot of savings. So
Right.
I can't see a reason why you wouldn't want to think ahead and plan ahead. But what was that threshold that you just mentioned? Is it $100,000 of earned income that
Yeah, it's
qualifies?
roughly $100,000 of adjusted gross income. I'm assuming that you're going to have at least the standard deduction. So I'd have to pull up um, the tax table, but the 12% tax bracket for a married couple is right around $80,000, and then you're going to get another $25,000 of standard deduction.
Mm-hmm.
So ballpark 100 to 110, you're maximizing that 12% bracket.
Do you have a sense of whether tax rates are going to change with the proposed um, laws for those folks who are trying to kind of capture that lower tax bracket, or do you think those increases will only hit individuals over 400,000 of earned income?
So far, most of the proposals have been for the higher brackets. So, individuals, like you said, making more than $400,000. I have not seen significant changes to the lower bracket. So these strategies should still be in place. That being said, if we roll our time back to 2016, the Tax Cut and Jobs Act, the initial versions of the plan versus when it went into effect in 2018 were significantly different. So we're still kind of at the beginning of the Biden tax plan, in my opinion, but we have some idea of the direction that they're going, which is higher tax rates, but particularly for the higher earning individuals.
Okay. So if someone is preparing for retirement or are in retirement, phasing out or phasing their expenses, taking money out of retirement account so that they're not artificially increasing their tax rate by taking large sums of money is one of those things that I've heard.
Exactly. You're trying to even out the peaks
Mm-hmm.
and not give away the valleys.
And should folks in retirement still consider a Roth conversion? Or is this something only that younger people who are still a long ways away from retirement should be thinking about?
I think absolutely. Anytime, I mean, to me, 12% tax is cheap, right? That's about as low as you can go. So if you anticipate being in the 12% brackets going forward, you could convert that account into a Roth, and then now it grows tax free. So you'll never pay tax on any of the increase in value.
And I suppose for those folks that do have a lot of money in relative speaking, so that they're potentially never going to need all of that money in a retirement account, by converting it to a Roth, they're also ensuring that they can pass that money on to the next generation. There's no, as I believe, required minimum distributions from a Roth either.
Correct. Yeah, whereas the traditional accounts, they have a 10-year, when you inherit a traditional IRA, you have to pull the funds out within 10 years.
Mm-hmm. Yeah, and you don't have to take a required minimum distribution at 70 and a half, I believe, correct?
Yeah, it's been moved to 72.
Oh, even out of a Roth?
No, sorry, just for traditional account.
Traditional, yeah, okay. Well, there you go. There's another reason to consider Roth conversion. I've always sort of not heard, but from a planning community, kind of the rule of thumb has been if you have a long time to continue working, earning, and saving, do a Roth conversion, do a Roth contribution before you get phased out, or use your employer's Roth option. And if you do convert, like make sure you have enough years to sort of make up for the tax that you just paid. But
Right.
I do like the idea of also taking advantage of the lower income tax rate for retired individuals and doing that Roth conversion as well. So that's a good tip.
Yeah.
What about folks that are, we have a lot of stock-based compensation? That was another planning area that you said you had some really good ideas around.
Yeah, so I mean, this is one where we actually get a lot of new clients that they, there's almost a missed opportunity, because stock-based compensation, it's often a multi-year plan if you really want to take advantage and minimize your tax liability. And a lot of it depends how early you're in with the company and the difference between your strike price on an ISO, for example, and the fair market value. Um, where to even start? The short answer is stock-based compensation is highly complex, and there are even a lot of CPAs aren't quite familiar with the rules and the tracking requirements. But the high level goal is to be able to exercise as much of the stock in order to pay tax at long-term capital gains rates instead of ordinary income tax rates, while managing the amount of cash you have on hand to pay the tax that will be due.
Mm-hmm.
So to the extent you exercise too much stock, too many ISOs, the strike price spread is too significant between fair market value, and you find yourself in AMT, you're required to pay potentially 28% on of tax on the value of the stock that you haven't sold. So you need to come up with the tax or with the cash to pay the tax, even though you don't have it, which is one trap, which potentially forces you to make a disqualifying disposition where you exercise and sell the ISO within the same year. And now you're paying ordinary income tax rates of 37% versus 23. So you're trying to save that 15%, is really the goal, which depending on how significant your stock options are, that could be a lot of money. It could be hundreds of thousands or more. It's also worth noting that to the extent you do pay AMT, you want to be certain that the company is not going to go under, right? So if you're exercising stock, you say, I have the cash, I want to pay AMT, but then that stock goes to zero, you've prepaid tax on something that's now worthless. So it's definitely an area that we regularly work with clients on developing a multi-year strategy so that, in a perfect world, they're able to exercise and hold shares without coming out of pocket to pay the AMT tax, and they get long-term capital gain treatment.
That can get pretty detailed pretty quickly.
Yes, I'm struggling to put it into, a simple, five sentence paragraph.
Well, I think that the main takeaway, at least for me, whenever we're working with individuals that have stock-based compensation, it almost always goes into one of two paths. They either get RSUs, which are relatively straightforward and simple, as I understand, treated as regular income in the year that you take sort of possession of the stock, and it goes on your W-2. Like there are some planning opportunities, but it's simpler than if you have any type of stock options.
Correct. Yeah, ISOs and non-qualified options just kind of throw a big giant curveball, and unless you're highly technical, it's going to be to your advantage to get support. To your point, RSUs, they are much simpler, in that they just vest according to the schedule. They hit your paycheck. The only thing I regularly see with RSUs is that there's a statutory federal withholding rate of 22%. And often individuals are in a higher tax bracket. So you might be under withheld by 10+%. And if you have a significant RSU vesting of $100,000 and you're 15% under withheld, now you're going to owe $15,000 come April. And, last I checked, most people don't have $15,000 sitting around that they want to spend on a surprise tax bill. So even just running a simple projection and taking your year-to-date pay stub, plugging the information in the tax software and finding out, what you're going to owe come April, this time of the year, it gives you, almost 6 months to know that you're going to have that bill.
This sounds like a tip that isn't so much a tax saving tip, but it's a stress saving tip.
Exactly. It's setting the expectation so that you know out of the funds that have hit your bank account, how much belong to you and how much still belongs to the government. Uh,
Right. And then if you have to sell additional stock to cover that or to generate the cash to pay the future tax bill, you got to be mindful of when you do it.
Correct. Yes,
Yeah.
definitely.
Um, one of the things that you were mentioning brought another question to my mind, and that is around stock options, ISOs, etc. And that is that while the custodian or the company that's administering the stock plan is supposed to keep track of all the cost basis and the spread and price, that they don't always do it correctly. And I've heard people say that they were discovered mistakes. And so unless they kept their own records, they could be, potentially increasing their tax liability. Now, is this still a fact? Is it something that you
It's
see?
I,
And
I
what
see
can you
it
recommend?
every single year. It's working closely often with the client and the financial advisor, because if we all kind of are communicating and know what to expect, then we can identify when something was potentially reported wrong. I've had major brokerages make mistakes that we were able to, get the 1099s reissued and saved clients tens of thousands of dollars. Um, and It's a little technical, but to the extent that I ever see a client with a AMT tax credit carry forward, um, I always ask if it's related to prior year exercise of ISOs and if they still hold that stock. Um, because when you sell the stock that you paid the AMT on and it generates an AMT tax credit, you're supposed to get a negative AMT preference, but it's not reported anywhere. It's up to you individually or your CPA to keep track of it. And it's
So,
it's often overlooked.
so give us some practical, simple tips on those folks that have stock-based compensation. Again, if you have RSUs, this probably won't apply to you, though you should still keep track of any stock that you have been promised and hopefully getting, and that it's worth something. But let's specifically talk about those that are, ISOs, non-qualified stock options. How do you best recommend keeping track so that when the time comes, that collaborative conversation can happen with their accountant?
It's a really good question. I'd say the biggest part is probably having the right team, just to work with you, and potentially not making significant transaction volume. If you bunch the transactions together when you're exercising the shares, I know you have the push pull of if the price is changing, you want to even out the variability, but it can become complicated to track the information between when you exercised it and when you sell it and matching the specific lots. A following year, 2 years, 3 years down the line, and saying, well, this is the 5,000 shares that I exercised in 2017. Therefore, my AMT preference was X. So now I need to do Y 3 years later. And being able to match those up can be difficult if there's significant transaction volume.
But what's the starting point? I mean, I guess that's the question that I have in my mind. If I'm a person or if I'm working with a new client that has a bunch of stock options that,
Mhm.
they just get these awards given to them every year or on a quarterly basis, and they get the brokerage statement that shows all of the shares, and they say, "Well, that's great," and they sort of move on with their day. But what I've been hearing and what I'm hearing from you is that it's worth keeping tabs on all of that separately. So do they should build a Excel spreadsheet just to say I'm getting this many options, this is the price, or what
It's
is the
when you
mechanism?
exactly. I put together a spreadsheet when we're exercising ISOs so that I can track the AMT preference.
Mm-hmm.
And you report it as one number on the tax return in the year of exercise, and then you have to remember to refer back to that work paper when you sell the stock in a following year.
Good. So keep notes, folks. Anything else you'd recommend for those that have stock-based compensation?
Let me see here.
I think especially as it relates to sort of where we are in the year, and we've got 2 months left
Yeah.
before December 31st. Anything particular, or are these just good general practices to be
Yeah,
mindful of?
these are good general practices. There is a strategy potentially with ISOs if you want to exercise them at the beginning of the year, because you then have the flexibility to decide to make a disqualifying disposition all the way up till the end of the year. So to the extent, this would be kind of for a next year planning,
Mm-hmm.
you have ISOs that you want to exercise. If you exercise them in January, you now have the flexibility of, do you want to exercise and hold or exercise and sell all the way up until December 31st. So if the stock loses value and you would be pushed into AMT, you can decide to make a disqualifying disposition. To the extent the stock increases in value, you can be days away from long-term capital gain treatment.
Well, that's a good point. So if you're thinking about selling or exercising some of your stock, just be mindful of to doing this year or starting in January 1st to give yourself more time.
Right. To potentially change your mind within the same tax year.
So I wasn't going to ask this question at this exact point, but it's important. And one of the biggest complaints that I hear, or I shouldn't say complaints, they're frustrations
Mm-hmm.
that I hear from some of our clients is that they say, you know, I'm surprised by something, or I wish I had known something earlier, or like, why hasn't my accountant said something to me before? And I guess what they're always saying is that underlying current is they're not getting a lot of proactive, like, let's sit down and plan ahead. It's more, send us your information and we'll prepare your tax documents and then tell you what you owe. And I think people that have any degree of complexity to their finances, and having stock compensation is one of those complexities, they're really looking for more of that proactive
Yeah.
relationship when they can be guided and advised, as opposed to just having someone file paperwork with the IRS. So, what would you give as advice to people on either engaging with their accountant, like when should they do this? And this is a great time for you to mention how you work with people so that, if somebody's looking for a good accountant, then they know who to reach out to. What is your process?
Yeah, I mean, that's actually probably the number one comment I hear from prospective clients as well. And I think it's just a lot of practitioners, they're more in the business of tax return preparation. I know our firm, we try to differentiate ourselves as being, more proactive, more involved. I'll say it on new client calls. I don't want to, win a new client that I'm only going to talk to once a year. We want to be available for when you're making those decisions. And, sometimes if it's an easy decision, should you lease the car? Should you buy the car? Let's have a quick 10-minute conversation about the impact from a tax perspective for your, self-employment income. But at least we had the conversation. So some of it's just, the relationship you have with your CPA. I know, some practices and particularly in tax season, it can be hard to keep up. You're focused on just getting to the deadline. So sometimes being a little flexible and kind of knowing that, there's certain times that are really good for planning, which is, the beginning of the year, the middle of the year, and towards the end of the year. At least from our scheduling perspective. Does that help answer the question?
Yeah. So, I mean, these are the three big times. I mean, that's why we're having these conversations right now, which is the end of the year, now that you finished your October 15th deadlines. And so, yeah, I think that does answer my question. So, before, let's just, I guess, move on to the next set of folks that you would want to give some tips to and best practices. I know you'd mentioned in an earlier conversation we had that there's some things that folks on the kind of younger end of the spectrum can also do, whether they're out of college, starting careers, starting families. What are some best practices as well as year-end tax planning opportunities that you might have for them?
Yeah, I mean, so someone just starting out, they're oddly enough very similar to someone that's just ending, right? They're in their lower earning years, but you have so many financial thing things pulling you different directions, right? You're maybe trying to get your first apartment, you got student loans, you got your first real job where you're making, potentially real money. If you're lucky enough to have any amount of long-term appreciated stock, you're again likely in the lowest brackets and potentially could recognize capital gains tax-free. I had an individual client that he had some stock investments, and he decided to take a year off between college and to travel before starting his new job. And he was able to recognize about $50,000 of long-term capital gains tax-free because he had no other income. Then, to your point, individuals with more runway on their career path, really trying to just front load that 401k or Roth IRA. I think the math works out somewhere where if you're able to, get $60,000 in there by the time you're 30, that'll turn into $1 million tax-free by the time you're 65 with, average rates of return. And so it can be incredibly powerful if you can just focus on saving. If you're making $50,000 a year, if you can park 4 of it into retirement starting at 22, you're just going to be so far ahead of the average American, which you might know off the top of your head, I think has $200,000 saved for retirement or something.
It's unfortunately less than that, but yes.
Yeah.
It's not much.
So, just anything you can do, and a few $1,000s a year when you're making 50, could potentially put you 5, 10, or 500, 600% above average.
Well, I would say most of our clients probably don't fit into that category. They're usually not hiring financial planners and advisors when they're out of college. But we have a lot of clients whose kids might be in that position or whose grandkids might be in that position. And I know that as a parent, and most people that we work with who are parents and grandparents, they want to help their rising generation and like giving as if they're giving advice to their younger selves. Like, these are the things I wish I had known when I was your age. And so we try to kind of impart this wisdom to them. And I mean, time is one of those things we could never get back. But when is the right time for a younger person who's just starting out to consider working with an accountant? Like, what should we tell our clients and as parents and grandparents to tell their kids?
It's a very, very good question. Sometimes it doesn't hurt to even just have an introductory call, right? Because you can learn a lot and get some tips. And I always like talking to new people. And maybe it's not, the complexity isn't there yet, but then who you might call as soon as you get that promotion, you move to that new company, you start hitting different life milestones. You want to talk about, buying a house, you're having kids, you want to fund 529 plans. Like, how does all this stuff work? But if you at least kind of get started on the right foot, and then check back in, right? It might be like, okay, look, yours is simple enough. You can do it on TurboTax, but give us a call if something gets more complicated. You've at least checked in, I would say.
Yeah, I mean, I guess building good habits is always good no matter what part of life you're considering. But when it comes to tax planning, it's one of those things that does have a bit of complexity. It's also one of those things that we naturally don't want to do. Yeah. We're not looking forward to. So I think it's good to develop that kind of muscle memory early on to know some of the best practices, avoid falling into those expensive traps that otherwise we'll fall into if we're not aware that they're there. And I think one of the traps that I see people fall into, and I always suggest you should talk to an accountant, but there are a lot of people who use, TurboTax or some other tax preparation software that's very, very good and it's very easy to use. But I also think that there are some opportunities that folks might be missing because TurboTax is not a human being that's able to ask them thoughtful and thought-provoking questions. Any suggestions to folks that might be using their own taxes to, like, what should they recognize? What are some of those either triggers or red flags that might want them to talk to an accountant?
One could be surprise balances due, right? You put the numbers in the software and you don't, the result is not what you expected. Actually talking to, younger clients or children of clients, I actually, will, sometimes the parent wants us to prepare the tax return, and I'll sometimes push back and say, this is a great, they just got their first job. It's pretty straightforward. Like, there's a great opportunity for them to, instead of taking a passive seat to their financial life and just say, oh, I'm going to hand my W-2 to my mom and my mom's going to hand it to the tax guy and they'll deal with it. Sit down and learn how to use the software, learn what the result looks like, go through the forms so that you actually kind of understand, how it works, how much you're paying. And to the extent that you don't understand, then, maybe get some help.
I think that I remember a while back, one of my associates said his favorite thing to do was read tax returns. And he's not a CPA, he was a financial advisor, but he's like, it just tells you such interesting stories. And, when I talk to most people, they say, my God, I just look at a tax return and my head starts spinning. There's just too
Yep.
many numbers and it's just, I'm done. Um, but I do like what you just said about kind of starting off slow and building an understanding of how these things work and how they're related, because they truly are very, very insightful and powerful if you can understand them early on. And it makes everything else going forward that much easier. So I guess that's a call to action for all of you that have kids graduating college. Yeah, have them take some ownership, not a passive seat, as Daniel just said.
Yep.
That's a
Definitely.
good tip. Daniel, anything else before we wrap up? Any whether it's year end tax planning tips or next year planning opportunities that you would want to leave some of our listeners with?
Well, let's see here. I mean, back to the changing landscape. Looking forward, we've seen a lot of activity around the estate tax exemption. So this is an area that Congress really enjoys playing with. It's gone, I think, in the last 20 years from unlimited to 1 million to 5 million to 11 million. It's gone all over the place. And if you're lucky enough, in the Bay Area to have, you own your home and you own, some investments, or you own a rental property, it's entirely possible that if the current proposal is to drop the estate tax exemption down to 5 million, that you might actually find yourself in a taxable estate. So there's, considerations for gifting assets prior to this new law potentially coming into effect. I kind of skipped ahead on the same point. A lot of individuals, aren't really thinking about, estate planning, right? Even on a basic level, if you're not going to have a taxable estate, we regularly ask clients, for their will and trust documents. And just avoiding probate in California, is significant. I think it's about $50,000 per million. So, if you just own a normal home, having your family or whoever you want it to go to be able to inherit it smoothly and saving $50,000, getting a basic will and trust in place is a big deal. So I think we're going to see a lot more movement around estate and gift planning in the coming months or year. So that's one. That's probably the biggest one that feels like it's on the horizon.
Well, I would just add to say that it, aside from the fact that it's 10 times or more cheaper to just get basic wills and trusts done today than pay that 50,000 per million in probate fees, that whole process is also very lengthy, and it's also public. And
Yeah.
a lot of people who want to keep their financial affairs private, and they want to make sure that, if something happens, especially untimely, that their family is not going to have to add kind of this additional stress, worry, complexity, and wait a year for the state of California probate court to decide how to distribute their assets. And I think that's a really good reminder to folks that estate planning is not just for the ultra wealthy. It's for everybody that has children, owns property, and has, what is it, over $100,000 that they end up being
Yeah.
forced into a probate court.
Yeah, and that 50,000 per million is excluding legal fees. You're
Mm-hmm.
likely hiring an attorney to help you navigate the court system.
Yeah.
So it's huge. And I think you can get, basic will and trust. Most attorneys, it's a few $1,000s. It's
Right.
relatively straightforward. And to the extent you have more assets, you're able to dictate what you want to happen to that with them. The default is assets go to your children, then to your parents, and then siblings, and so on and so forth out. But what if that's not what you want to happen? So getting
Doesn't
those
directly
documents
relate to what you do for people. So, folks, don't call Daniel if you want to get a
yeah.
will and a trust done. But it's a really good reminder that have a team around you, and that having a team around you that each focus on different areas of your financial life can help put them all into the right order. So I appreciate you
We
bringing that up.
if we had an attorney on the call, we'd have the three most important parts of your financial team:
Sure.
your CPA, your financial advisor, and your attorney. And you bring in the different parts depending on what aspect you're working on.
Um, Thank you for that reminder. That's true. Anything else that you might recommend folks to consider before year end or as they look ahead into next year?
Well, if you're just kind of getting into year-end planning, if it's not something you've done a lot of, we actually, along with a bunch of firms, will put out a year-end planning guide. So we have one on our website that goes through a lot of the topics we've talked about today, along with other options and other considerations that we haven't had time to go into. And it's a great way to kind of read through and think about if any of them are relevant to you. So that's a really good resource. And the other thing is just, getting connected with your accountant, getting a handle of where, if you do the work yourself and you're preparing your own tax return, kind of looking at, how the year's gone, and even if it's just looking at your pay stub. And the IRS has a basic software to check your withholding. It's actually pretty good that you can use, and it'll tell you if you're behind or ahead, and if you have a projected balance due. So even just using that can be valuable. And checking that you're on track with your 401k. If you want to max out the 19,500, and you see that you're going to come up $1,000 short, you can get in touch with the payroll department to change that. So there's a lot of little things that just spending the time to just look at it all and make sure you understand it, and you're being proactive about where you stand rather than just letting the ship sail.
And Daniel, would you be able to share that checklist or that document that you referenced?
Yeah, we have a link to it.
If it's something that we can also share with our client community, I'd love to include that in the notes when we send out this recording.
Yeah, definitely.
Perfect. And all right, well, on, I guess, closing note, I want to thank you for taking some time. I know you're volunteering to share some of your insights with our community, and I appreciate you doing that. And tell us just in closing, what kind of situations, client profiles are you generally working with, so that if folks are looking for a second opinion or for an accountant to work with, that they would know that you might be the right fit for them?
Yeah, all the way back to the beginning, we work almost exclusively with closely held businesses and individuals with some level of complexity. So I actually one of the things I enjoy most about my job is the wide variety of clients I get to work with. So I work with anything from architects, engineers, designers, welding company, a social media marketing company, individuals with stock-based compensation, real estate, they're self-employed. And then, we do have individuals that are, retired, they're collecting more passive income. So it's really a pretty wide variety. But, like I said, some level of complexity.
Yeah, and one of the things that I really appreciate about your firm, and I've had a relationship with your firm and other folks and partners in different offices, is that you guys are local, you're Bay Area, but you still have the extra, I guess, kind of horsepower of having associates, and you work as a team with a lot of your clients. And so it's not just a single operator, perhaps, where they might get overwhelmed with some tax filing deadline, and all of a sudden you can't get somebody on the phone. And I do always appreciate that.
Yeah, that's correct. We actually, for a local firm, every single client has 3 people assigned to them. So there's always a staff accountant, a manager, and a partner. So depending on the complexity of the question, you have 3 people you can reach out to that might be able to help you. So that's, I think, incredibly valuable as well, to have a whole team behind you.
We agree. So we'll put your information and any resources that you'll share with us in the show notes when we send everything out to our client community. And so again, thanks very much for being here with us today, and I appreciate you sharing some of these tips.
Great. Thanks for having me.
Take care, Daniel. Thanks.